Kristina, let me start with you on the reaction of the markets to this CPI and PPI numbers. Some encouragement. Does it sort of suggest maybe we're heading in a better direction?
David, we're definitely heading in a better direction. It looks like we're past peak for inflation, but the problem is inflation is still very, very high. If we think about the Fed's inflation target of 2%, we're way far away from that, and it's going to take us a significant amount of time to get there. But this is the first step in that direction, and so it's progress.
Joanne, I think the market sort of thought maybe we can back off a little bit.
Well, the market, I think, might be a little bit too optimistic about how much work the Fed still has to do. Yes, the numbers have been good. In fact, core PCE inflation looks like it peaked back in March. We got that information, and that's a positive. And we're starting to see some of those items that were in really short supply now start to become more available, and that's helping to take the price pressure off. But we are, as Kristina said, we are a long way from 2% inflation. Although the long-term expectation for inflation is, closer to 2%, we still have a lot of work. The Fed has a lot of work to do in the short term. So I think the market might be a little bit too optimistic about the path of rate increases. And I think they're going to continue to rise over the next few meetings at least until the Fed is really convinced that inflation is moving in the right direction. And because they're data-driven, they're going to wait until enough data has really piled up before they shift their focus, I think.
So, Kristina, take us over the next month and a half or so, because we got Jackson Hole first, right? We'll hear from Fed speakers, including Jay Powell. And then there's a fair amount of data. I think we get another CPI reading or two. We get jobs numbers reading, things like that. Where do you think the Fed will be come September?
Well, I'm actually going to go out on a limb, David, and say we're probably going to be in a place where the Fed feels it should err on the side of a little more caution. Right, we've gone at a pretty breakneck speed in terms of back-to-back 75 basis point hikes, and the Fed is, as Joanne said, very data dependent. So it's going to be looking at data and seeing that longer-term inflation expectations are better anchored than they were, and they are going to see inflation moving in the right direction. Inflation growth is obviously still an issue, so they're going to be hiking rates, but they don't have to be as aggressive. So perhaps they signal it in a Jackson Hole speech. That might be too premature, but I think by the time we get to September, October, we should see a Fed that pivots to a less hawkish tightening stance.
I think the critical data, in addition to what you just mentioned, Kristina, is going to be the employee cost index, that ECI. Right? We know the labor market is very tight, and we're concerned, right, that wages are going to continue to rise, and that's going to put a floor really under price inflation as those bleed through into prices from firms. And we're seeing that a lot. We're seeing firms actually be pretty successful at raising prices in the face of those higher costs. So, if job openings drop and some of the heat comes out of the labor market and we don't get as large increases in wages and overall employee costs, then I could see the Fed, becoming a little bit more at ease about the number of rate increases. But right now, the wage pressure just looks really severe, and companies are still clamoring for workers, even as we hear about these anecdotes of Peloton, firing hundreds more workers and others. But a lot of those that are, announcing firings are the ones that were right in the center of the pandemic benefit in terms of just massive business expansion, and they're now having to dial back. So we'll see if that spreads more broadly across the economy.
Joanne, I would argue some of the heat is already coming out of the job market, that we've seen a drop in the number of job openings. It's moving in the right direction. And of course, we are seeing companies in earnings calls talking about how they're going to be more cautious in hiring or actually implementing hiring freezes. And of course, we have heard about some layoffs as well. So I think this is an environment in which we're going to see increasingly lower level of labor mobility, and so that should help tamp down upward wage pressure.
Joanne, I'm curious about your take on the risks faced on the one hand by the markets and on the other hand by the Fed, and whether it's the same, because there is a risk in backing off too quickly. I mean, we say, boy, the inflation's down, headline and core, but it's still pretty high. And even with wage increases, they may not be as high as they were, they're still pretty high. For the Fed, do they have to really be concerned about the appearance that they're backing off too soon?
Yeah, I think they do have to be concerned about that because their main tool for getting this right is creating the correct expectations. They really have to convince the market, firms, workers who might be out there clamoring for raises. They have to convince them that this inflation spike is a temporary one. And so to back off, too soon would potentially, lead the markets to think, okay, this could get out of control. I agree with Kristina. We have seen some softening in the labor markets. Job openings did come down a bit, but there's still nearly twice the number of the unemployed, and that could be a little bit of a mirage, right? We could see more firings, and that's a backward-looking data point, we know. So, that's why I think we will know a fair bit more over the next couple of months. But the Fed, I think, cannot err on the side of looking like they're going to ease off if the data is not really strongly supportive.
Kristina, we have to talk about the possibility of a recession and the yield curve, because we've had the 2s, 10s now inverted for an extended period of time. It's somewhere in the 30s right now. It got as high as 58. What do you see in terms of the risk of a recession at this point?
Well, actually, David, I would argue this week was a good week that increased our chances of avoiding a real full-blown broad recession. I think the Fed, it's going to be a little bit easier for the Fed to execute a soft landing, but that would mean that the Fed needs to pivot to a less hawkish tightening stance sooner rather than later.
Do you agree with that, Joanne? What do you think about the chances of a recession?
Well, I think it's probably the case that things got a little bit brighter in terms of the outlook with the data we got this week, with those inflation numbers coming in below expectations. Clearly, short-term interest rates can go up, even significantly, without triggering an inflation. What we're watching is really the longer-term interest rates, right? So the yield curve being inverted doesn't surprise us. It seems actually kind of a natural outcome of the Fed trying to deal with what hopefully will be a short-term inflation problem. So you have, the shorter term interest rates, the 3-month, the 2-year, et cetera, spiking up a little bit as the Fed moves. But provided that the 10-year remains anchored close to the level where it's currently sitting, that doesn't then materially raise the cost of doing business for firms. It doesn't raise mortgages as much. It doesn't raise the cost of financing durable goods purchases. So it would tend to have less of a drive towards, any recessionary dynamic than just having the short-term rates go up.